Welcome to Breaking Banks.
Hey, as we are wrapping up one year and getting ready to launch another, we're catching up on, what the future is going to hold. And I would say if you were to go back to our wrap of 2019 and the trends for 2020, no one said global pandemic. That was missing from every one of our bingo cards, including our longtime friend and contributor of Breaking Banks, Jim Marous. Next year, I expect you to be better on your global catastrophes, Jim.
My predictions, yes.
Yeah, work on that.
I missed a pandemic, I missed social unrest, and I missed an election that didn't become final for 2.5 months. So, yeah. I missed all the big ones.
Yeah, did you have a hack of the U.S. government?
I kind of missed that one too. So, I'm got to be replaced next year. That's what the deal is.
Yeah, exactly. Well, maybe it will be Jonathan Prince, who is special guest today. Jonathan is the co-founder of Finologee, a Luxembourg-based fintech and regtech. And we also have another frequent contributor, Lindsay Davis, head of markets at Atomic, former fintech analyst at CB Insights. And last, but certainly not least, Brian Solis. Brian is a global innovation evangelist for Salesforce. Sounds like a pretty sweet gig to me. And I'm not sure what a global innovation evangelist does, but I would like to sign up for that, especially if it gets me out of the basement we've been podcasting from all year. So why don't we kick off, Brian, with you? What is your favorite holiday cocktail or mocktail?
Oh, Lindsay and I were just talking about this. It's just champagne, just good old beautiful champagne.
Yeah. Jim, how about you? You've been at 2020 was such a health kick for you. How has that evolved? Or are you going to break down for the holidays and go back to old habits?
Not old habits. Can't afford to do that. As far as a cocktail, I don't drink very often, but when I do, I do enjoy a Moscow Mule or just a cold beer. Now, mind you, when I was in California last week, I got hooked on this coconut water infused alcoholic spritzer, which was cucumber flavored coconut water spritzer. And I'm going at like 5.5% alcohol, put a couple of those down before I golf, and it got better.
Yeah,
that must be Southern California. It almost
sounds healthy too.
Yes, exactly.
Yeah. So Lindsay, it is your birthday month, and Brian already called it out. You both are toasting with champagne. So Jonathan, how about you?
Well, I'm on gin and tonic. I'm a British national, so even the Queen drinks gin and tonic, so we have to. I've got my glass of gin and tonic now. It's a bit later than you guys because I'm in Luxembourg, indeed, as you said. And so not only have I got my glass of gin and tonic, I've actually got my own bottle. So, but as Jim said, you're not to drink too much, ever, especially if kids are listening to the podcast.
Yeah, we're really big in the under 21 segment that really cares about, thinking, regulation, innovation.
They all dropped out, yeah.
You laugh, but Gen Z is extremely active and vocal in their financial services, and they're driving a lot of what's going to happen next. And I know that there's going to be some debates on this topic. They don't look rich yet, but they're going to be. And they're
why don't we start with that, Lindsay? Why don't we pick into Gen Z? Why are they the future? And if you start with the greatest wealth transfer in history, I'm going to find you on this line, and you will be mysteriously dropped. But go, give me the counterpoint.
Well, we do know about the global wealth transfer, which is roughly $16 trillion, will cross hands over the next decade. People have assumed that will pass quite quickly. We think it'll be a slower transition, and fintech is enabling that. Now that fintech is fully integrated into the mass market as a result of branch lockdowns and being forced to move habits online, I think you're going to start to see that wealth transition in a more digitized fashion. I mean, a lot of the barriers that exist today are somewhat artificial. Limitations around how much money that you can send between peers is limited in a bank-to-bank network. And we've experienced that directly in the fractionalization of of assets that we've been trying to pass on to one another. But the point being that ultimately Gen Z is going to drive what the next iteration of fintech looks like. And increasingly their experience is on demand, real time, and the barriers that exist today haven't evolved quick enough. And either banks have just adopted technology as a result of the pandemic. But the point is, now that the consumer knows that they have that experience, that's their expectation. You can't come back from this.
So you pull on this, greatest wealth transfer, and yet those are big numbers, but we're also talking about a much larger population in the fact that it does go, slowly. But I think the point that you hit that hasn't been talked about as much as maybe it should be, but this idea of digitization and fractionalization and the trend that's going. Now,
Yeah.
Brian, you talk about this, quite a bit. And what's your thought? Greatest wealth transfer, is that the future, driven by Gen Z's, the future of fintech?
I mean, by the nature of just evolution, absolutely. I also worry about the transfer of debt that they're going to have to take on as well around the world. But one thing that I focus on as a digital anthropologist is the cross-generational trends that we're seeing. So not just Gen Z or this centennials, millennials, et cetera, but also what has this pandemic done to the trajectory of consumer behaviors at large? With many becoming digital first, of course that happened before the pandemic, but also with shelter in place. I'm here in California right now, where we're going through our second wave of shutdowns, and you have no choice but to be digital now. So you have to act like Gen Z if you want to survive. And that changes you. Subconsciously, it changes how you make decisions. It changes what you value. It changes your beliefs. It changes all kinds of things. And so banks are really going to have to pay attention to what's happening now, because it's bigger than any one generation. It's actually an entire swaths of markets.
Well, beyond that, I think we look at the entire changing of the way banking's looked at. So instead of services or product lines, a Gen Z person doesn't look at it that way. They look at it as my transactional money, my borrowing money, and my savings money. And I want those flows to be automatic. I don't want to have to do a doggone thing about it, but I want those flows into savings to happen when I have more money. I want the accessibility for credit, not loans, but credit on demand in a digital world. And we think about the longer term implications. Embedded financial services is going to become paramount, especially when you're having to have a millennial or a Gen Z person having to finance their parents or their grandparents' nursing home expenses, different things. They don't want to sit down and be writing checks. They want this to happen automatically and have really a financial concierge that will help them make the best financial decisions. Most of us go back to, we mentioned MX earlier, to the MD days, where it was, let's see how I can make the best budgeting app. People don't want to budget. They want budgeting. So they don't want to do it, but they want it. Well, this has all got to be seamless. And I think the other aspect of this whole thing is, I think talking about digital is going to become a 2020 issue. It's all about experiences. And that sounds like it's about the same thing. But the reality is, what am I going to get? How are you going to be looking out for my financial well-being, as opposed to how you make me able to be transacting easier?
Well, yeah. And Brian, I want to bring that back to you, because I think Jason and I both have a fair degree of skepticism. While we agree with the underlying premise, right, of some of these generational things, what really I think the skepticism is around, look, 77 million people born between this date and that date aren't a monolith. They don't all make the same decisions, want all the same things. But the nuggets of truth in there include life-changing events that happen during formative times of your life. And you've written a lot about this. And what you've been talking about lately is now Generation N. And can you talk a little bit about Generation N and what does that mean to you?
Yeah, so as a digital anthropologist, I try to humanize a lot of these changes so that executives can make decisions based on data and insights in ways that don't just talk about digital. It actually gives digital a purpose. So before the pandemic, or before COVID, or BC as I call it, there was Generation C, where the C stood for connected, and essentially it was what you had said: cross-generational behaviors. We look at, for example, the Millennial Disruption Index before COVID had said that when they surveyed millennials about what banks that they will foresee that they will do business with in the next 10 years, the top three answers were Google, Amazon, and Apple, none of which are banks. And but the reality of that was to show just how deep the mindset was in terms of digital innovation, how people naturally think. If that was their go-to answer, what else could it be? It turns out that if you ask people who are 45 and 55 who live a digital first lifestyle, they would have the same answer. And when you then look at what happened with the pandemic, or AD, after disruption, the something happened beyond just digital. Of course, we all had to become digital. And what happens when you become digital first, you become, I jokingly call it an accidental narcissist, but you are at the center of all kinds of things. You want things faster, you're impatient, you're demanding, you expect experiences, as Jim called out, that are personalized, intuitive, congruent. You are making decisions like things like D2C become just like the new norm in your life because it actually caters to the way you make decisions. And then lastly, though, the big thing that was different from Generation C and what gave birth to Generation Novel was the somatic marker that is this disease. And what happened, though, is if you were in any place around the world that's affected by the supply chain, you're never gonna look at an empty roll of toilet paper the same way again, right? It's like it's at the end of World War II, where everybody who survived had a new sense of values, a new outlook on life, how they save money, how they spend money, where they spend that money. It's all different. And also, trust becomes a currency. Most people are saying that they are now making decisions about what brands are going to do business with moving forward based on how those values align with theirs, how they responded during the pandemic, how they treated customers, how they treated employees. And then 60%, according to Salesforce study, just found that now everybody expects that the business that you do business with wants you to play a societal role, not just corporate social responsibility, but actually taking a role in society's evolution. So that's the premise of Generation Novel. It's helping executives understand, how do you design a bank, how do you design new products and services for a generation that's cross-generational, but now has different needs, different expectations, and different behaviors, because those are the insights that should guide your innovation strategy.
Well, and one of the things that I suspect, I mean, there's plenty we don't know, right? We're sitting here still in the middle of the pandemic. As Jason pointed out, we didn't think about this a year ago, and I don't think we're going to be real great in our prognostications a year out from here. We don't know all the things that'll be, lasting and which ones will go away. But the semantic marker, as you say, really is impacting all of the generations. And Jonathan, I'm wondering from your perspective, particularly in Europe, but even your global perspective, what are the things that you think seem to be more long-lasting in the changes that people are going? What kind of habits do you think are going to stick even after we have the pandemic under control?
Well, I believe that in general terms, that banking is something you need in your daily life. So you make payments, you get a mortgage, and so on. So it's not going to change radically from that. But and I agree with what has been said up to now. It's basically it's the behavior, the habits that are changing. And one thing that maybe I would add to what has just been said is that this global pandemic has clearly driven people who were not digital natives to embrace, these the mobile phones, the way they now it's a given fact that people are going to order online, use their phones, and maybe to reflect on what just been said. If you look at Alipay, for instance, the payments part is a commodity, right? So they're not offering payments as so. They're offering basically a way of booking your cab, your taxi, the airline tickets, and so on. So it's the services they're providing, which are nothing to do with payments or banking services. And I believe that in the near future, banking services and products will also become a commodity. And the fact is, the banks have to adapt to that. And they have
are we there already?
I hope they are, actually. And
no, my point is, aren't we already at commoditized products and services today?
No one's told the banks yet, though, JP. So quiet.
We'll keep it a secret.
It takes a lot of time for a bank to switch from what they actually are, which is providing a banking service or product, to a digital company. This is a totally different business. It's a cultural shift that is impactful, and so it's from risk mitigation, managing assets on behalf of for people. Then you have to basically think differently, adapt your tools, provide interfaces that are actually not just about banking. That is a major change, actually. I think that's the probably the biggest challenge for all these global players, first of all, and not speaking of the small and medium-sized banks, because the cost of that is going to be huge.
Yeah. So, I mean, Lindsay, when you were at CB Insights, you were pioneering, this theme around unbundling, right? And by like the fifth time that graphic came out, you couldn't even tell what was in the background. There were so many startups, and that trend has now gone into, there are so many big tech companies driving into it, as Jonathan was saying. In a debate you and I often have is really around now the rebundling, and as Jonathan alluded to, the embedding. What's your prediction for the future? First around the rebundling and then embedding.
Yeah, so let's take a step back and say, what happened to enable that first iteration of unbundling? So if we go back to 2008 and the financial crisis, we saw fintech companies targeting, very underserved parts of the market, lending to start, and then robo-advisory. And those business models have underpinned what is now the next generation of those services. Now, every financial institution competing in those markets has a competitive offering, whether that's a robo-advisor that charges a standard, percentage on the AUM, or it's a free brokerage. The next generation that we are sort of joking about, they're not going to know how much it costs to trade. They're always going to expect it to be free because now everyone has that. So from that, then one business, that company needs to move into a next line of business, because they're using certain services and features as a loss leader to acquire customers and assets. They are largely rebundling the bank, as we say, moving from a monoline service to a multi-line service, and offering things like savings accounts and checking accounts and high yield savings, and things that get you closer towards monetizing that base in a more high quality manner. There's been a lot of complexity around how the consumer controls those relationships. And this is part of the big thesis that we're betting on at Atomic, which is that the paycheck is really, and payroll, and the ability to understand, where your money's coming from, is really going to unlock the next level of financial freedom for consumers. So we keep calling it banks, and Jason and I have this conversation around what you can and can't say. Certain, companies without charters in the US are not banks, versus in Europe, you have open banking and you have the e-money license, which is a smoother transition to getting a license. We don't have that in America. And it's extremely fractionalized in terms of, who's got what kind of service. We only have a couple that have been able to go through the charter process successfully. And that might ease up, but the recent regulation that came out from the FDIC around broker deposits and really fostering a partnership between fintech companies and the financial institutions that can take those deposits, because not everyone wants to be a chartered financial institution. They want to serve their base in a consistent way, and the regulatory onus on that is a bit cumbersome. So for them, if I only want a fraction of the deposit to service my customer because I'm a brokerage provider and I should only be putting a certain component of our paycheck in that account to then go invest, well, we can enable that at the point of payroll with what we're building at Atomic. But any company that's thinking through how do I attract this base has to give their consumer options. And that's what I think is really the next big trend that we should be paying attention to.
Well, it's interesting because we talk about open banking and the potential for open banking. The reality is
I'm cautious there, though. However, open banking in Europe is a regulatory framework that we don't have here. So by saying
we don't need it because the consumer's driving open banking themselves.
Yeah.
The consumer's driving what they want to be part of their financial relationship. They're not going to be sitting there and asking PNC Bank to tell me what options I have for brokerage options when I can build those myself.
But however, if you keep your assets at PNC, if PNC doesn't have open banking by the standard, they can block a aggregator's access to that.
They do already. They do already.
Exactly. That's my point.
So guess what?
They don't care about their consumer.
And I unwind my banking relationship because of that. They do not.
It's not easy. It's not easy to just switch your direct deposit over to any financial.
I don't. But in a digital world, I don't need to close the account.
I love that Jim.
You do need to close the account because then you're going to get charged fees on that account if you have a minimum there.
Okay.
Maybe you don't, but the average consumer does.
Well,
there's a $38 billion overdraft bill that is paid by the under.
But they're not by people trying to.
Not by you.
They're not by people trying to close accounts.
I want to hear from Brian on this. Is the tiebreaker from a research point of view? Do people actually vote with their feet on this debate?
Vote with their fingers.
Yeah,
if they could vote with their feet. Again, there's friction to do this.
Absolutely, but we're moving towards this digital world, Lynn. Right, we're moving towards the digital world, and where it is getting easier. And, Jim, why don't you finish that thought? And then I would love Brian to jump in with what he's seeing. As we're taking friction out and the U.S. will never have capital O open, capital B banking. We're going to have lowercase open banking, right? That's being what I think you're proposing is being forced by the consumers, right? Like, is that where you were headed?
They're basically, I'm constructing my own relationship around the banking ecosystem. On top of that, though, I think open banking in the future is really going to involve a lot more in the non-financial area. We're already seeing this in the UK. We're seeing it much more in the Emirates. We're seeing it in India. We're seeing it in China, where more and more services are being offered. And actually, the whole dynamics of funding a relationship is changing, where outside players are helping to make it so that account relationships are valuable. We have Live by Acacia Bank. We have, I'm sorry, Acacia Bank is not Live. Emirates MBD is Live, and Acacia Bank has Imagine for the underserved, well, actually for the very young consumer. But they put in gaming programs, music programs, discounts on tech, all this. But those third parties are helping to fund that relationship to make it so that it's valuable. I think that's where we're going. And Lindsay, I don't disagree with you. I think the seamlessness of getting in and out of relationships is going to become very easy out of necessity. And you're going to have to compete on the whole area of experience. If PNC Bank, Wells Fargo, Bank of America, whatever, makes my experience better than anybody else, I'm not going to leave. I'm going to wait for them to add the other elements. But I may still have my Acorns account. I still may have my Robinhood account. I still may have my PayPal account, which is actually my strongest small business banking relationship is PayPal, because they offer pre-approved lines of credit without having me go in anywhere. And I'll pay. By the way, I'll pay more for that relationship, for that line of credit, than I will with PNC, because basically PNC is going to take a week and a half to give me an answer. And I'd rather have the speed.
Agreed. I think we are both aligned that
you
as the consumer will ultimately inform the product roadmap of where these businesses go. And our loyalty will be predicated on their ability to service us and their ability to be transparent. I think that's what's missing a lot of the times. Brian?
Well, I'll just, I'm sorry, I'm busy banking.
As he whips out a mobile phone.
Yeah.
My Venmo is.
I actually really appreciate everybody's points on this. I can only come at this from what my research kind of points to, and it's not anywhere anywhere near fact, right? It's just an idea that when you look at almost 80% of UK consumers switching or considering switching to a neobank, what that tells me is that they're in a position where they feel forced to make a decision whether it's easy or not. And when we look at open banking and just the tech of it around the APIs and of course regulation, the easier this stuff gets, the easier it's going to be for the consumer to make decisions across the board, regardless of where that paycheck goes. And I think that future ecosystem is very representative of what we're seeing in retail with D2C, right? And then if you look at innovation in terms of services, policies, whoever that is, whether it's a big bank or a neobank, the easier that becomes, the more we'll see unbundling, but the more we'll go to Lindsay's point. At some point, it'll have to be rebundled just for the sake of sanity. And it'll be a much more intuitive, much more human, and a much more aspirational style of service rather than transactional, the way that we see in banking today.
So time for a quick break. When we come back, why don't we pick up, Jonathan, with you talking about, Finologee is right in the center of this. The UK is further ahead because it started with the EU with the regulatory mandate, but look forward to more spirited debate as we go into a break.
Well, Jonathan Prince, we talked in the first segment about open banking, as Jason said, kind of lowercase, but in most of Europe, at least, it's capital OB. It's the law of the land. What are the changes that you've seen coming so far, and maybe take it back to what you were saying earlier about this idea of commoditization? Has open banking helped or hurt the commoditization of banking products and services, do you think?
Well, actually, if you look at open banking, as you said, it's basically it's the European Commission who's forced that onto the banks, and maybe a bit just after the 2008 crisis, but it comes after other industries. The telecom industry was impacted 15 years ago. It's the goal also of the European Commission to foster innovation and competition in this area, right? So that was actually the baseline of what they call PSD2, Payment Service Directive 2, also known as open banking. And you were right to say in the UK, they started about 2 years prior to when it was transposed in the rest of Europe. But it was basically more an initiative of the leading banks in the UK, right? So they defined a standard. They obviously had this idea of bringing more services to the customers. But in Europe, it's actually probably not going to fly as we would, as consumers, all expect it to fly. It's not going to be very impactful, because there's one thing that is probably going to kill the user experience, is that there is a strong customer authentication for each and every transaction. So that's going to basically kill the user experience. But still, I think we have to look at it as a global trend, right? It's the draft. It's gonna be the first step. That there will be. Would it be called PSD3 or something that will go beyond payment accounts, which are actually the only accounts that have to open to third parties? So what about the saving accounts? What about the securities and so on? These are not in the scope of PSD2. So open banking, as we see it in Europe, is probably limited in terms of usage. But still, you were right to say that it was, first of all, a political decision, right? And this idea of, well, fostering innovation, indeed. So there, I think that's this first goal was reached, because the banks have to start being creative. They need to understand. And I'd rather talk about actually open finance more than open banking. It's more a APIization of banks, and they've got for a lot of them legacy infrastructures. They're using legacy core banking systems. It's very difficult for them to switch to something that is in line with the expectations of you, me, all of us, the consumers. As we said.
Well, that was how PSD2 was kind of a leveling function for all of that, right? They had to go through that European Banking Industry Commission, forced everybody to open up certain pieces of data to around certain API standards. And I think Jim and Lindsay are right. That's not going to happen in the US anytime soon. But what that did in Europe was kind of commoditize at least parts of the banking industry. But then I guess my question is, did that build a stronger base upon which more innovation can go on? Or is it better to just leave it all to the open market and let the individual players figure it out as they do? I mean, Lindsay and Jim certainly have their thoughts about that.
Yeah, I'm sure they have. It's very different from the US perspective. China
Sure.
and Europe is very different. But
yeah,
as we all know, that in Europe, sometimes the order has to come from the
right.
the politicians and the European Commission putting.
So net though, I mean, we're what, 3 years in, 2.5 years into
it
formalization.
It was in fact transposed in September 2019. So it's a bit more than a year and a half now. Actually, you see some players, some third-party providers that provide these apps that are fantastic apps with an aggregated view of the assets, and that you can move some of your assets and so on. So basically, it's I think going in the right direction. Does it mean that the banks are actually embracing that? I'm not 100% sure. Still, they have to comply with it, right? Some of them, and I believe the big players, those that have had or have a forward strategy, right? Looking forward, saying what are we going to, what kind of role can we play in the future and become either a bank as a platform, a bank as a service, and some of the large US banks are doing that, which is, I think, quite an obvious and smart choice in that sense, but not all of them will be able to play that role. I believe there's going to be a sort of concentration effect. So there are going to be loads of M&As going on in the upcoming 5 to 10 years. But for the benefit of the consumers, I hope, I expect it to be also something that will benefit to all of us in Europe, because you were talking about these neobanks, right? They're wonderful. Most of them are losing money for the time being. Some are starting to generate money, which, I started in this industry almost 10 years ago, and we didn't talk about fintech at the time. But the plan is interesting. They started with payments, all of them, because payments is 80% of the touch points with the end customers. So you start with that, you build on top of that, the relation, you do mass onboarding of users, you get your critical mass, and then you start adding the credits, you got mortgages and so on, which indeed is a winning strategy. We'll see on the long term, but it seems to be quite successful and getting more and more traction. And it's different approach from the Chinese Alipay, Tencent, and so on, but it seems to work. And well, in the US, you have also some players there, and they proved that this model could actually work, and they're threatening the incumbent players. That's
well, are they truly threatening? Because at least in the US, some of the most innovative fintechs are actually the biggest banks here, either through acquisition or they've shored that up. And one thing that you made me start to think about, normally we talk about it from a regulatory point of view. The disadvantage in the US is we have this absolute patchwork approach at both the federal and the state level that can make it hard. But recently recorded a show where we talked about it actually also creates some opportunity. There's some arbitrage and some flexibility. that when we think about innovation, this idea of it not having a mandate, the mandate makes it very well coordinated. But the downside of this is it also is kind of a patchwork approach to innovation. Jim, I'm curious how you see that playing out.
Yeah, it's interesting as we're talking. Yeah, as many of you know, I continue to say is we talked in 2008 about too big to fail, and my comeback now, and certainly Jason and JP have a stake in this, is are many organizations, especially in the middle asset range, too small to succeed. I can see how the small financial institution can make it because of community investment and community commitment and all these things. But you're starting to see some mergers. You saw Huntington this week announce a merger with TCF up in Minneapolis / Chicago / everywhere. Is that big enough? I mean, I don't think number 12 is big enough. In fact, you almost get in the stickier stuff. Truist is trying to do it. We'll see. Because the reality is you take all these savings you have and when you close down overlapping branches, and you really put it toward technology, you put it towards loan loss reserves, and you put it towards other things. Do you buy stuff, or do you change your culture? Which really, that's where it's at biggest risk. When I'm looking at these smaller organizations, it's not the investment level, because really investing in good technology and in great partners has gotten less and less expensive. Even the cloud has gotten reasonable. But can you change the culture? And when you get in this mid-sized organization, the culture is all legacy. And the CEO, Dan Snyder from Lemonade, said, the biggest inhibitor of digital transformation is legacy leadership. And I don't think I've ever heard anything that's so profound, because I just go there and go, that's the thing that holds up everything. I mean, Jason and JP, when you're working with LA Labs and everything, I would imagine that even with these organizations that commit as an organization to do something good and move forward.
Yeah, it's funny you bring that up. We just had our annual meeting where we set our priorities for the coming year, and the COVID's benefit was these banks, were already some of the front runners in moving fast. But it wasn't about new technology or let's do more, with data and analytics, those sorts of things. Some of the biggest emphasis that our members were asking for next year is cultural change, because they're realizing, their leadership gets it. The front lines that are dealing with it get it. But there's this middle layer that's really hard to change, and they have no incentive to change it because they've done it like this forever. Now, I'm curious, Lindsay,
job security, they're scared to death of that amount, am I going to be outplaced by a robot? And mind you, that's not what's going to happen. But you're going to be outplaced by new thinking. If you can't buy into what the future can be. And I guess I keep on coming back to these middle layer organizations, which is 3,000 organizations in the United States. Is there a place? Is there a sweet spot that they can take advantage of without dramatically changing who the organization is? Or do you have some major digital player that comes in and says, I'm going to scoop up all these underperforming assets in much the same way that is happening in retail right now, and I'm going to build a digital platform where all these will move more efficiently, more effectively, and I can take the loss because I'm going to sell the real estate. Now, it's not the best time to sell real estate right now, but is there a platform for that?
And by assets, do you mean customers?
No, assets being physical assets, structural assets. And take this one step further. What role does Googleplex play in this whole dynamic of where the industry is going to end up going?
I think it plays a cultural role. It plays a cultural role that we're all thinking about, which is that Google is designing a product for, first and foremost, its customers, the people that use Google's products and services. It thinks deeply about product design. How do we engage our base of users, which is the thing that is missing most at banks. That will absolutely be paramount to moving forward for any financial institution. Shatter the customer expectations, be customer centric, and be customer first always in whatever you do, no matter if you have, the sleekest core or, have your assets managed on the cloud, which is more secure. So the fear of, I think, fintech has been reduced in that side of things, but there are security protocols, and many fintech companies have gotten sharp on compliance, which was a 2019 prediction I had, having been a compliance and regulatory auditor. I looked at the space and I thought, well, if they're going to be doing, chartered financial services, then they are going to have to get sharp on compliance. And unfortunately, 6 years ago, when I was trying to leave being an auditor, that was not necessarily the cultural view. They thought it would be detrimental to this idea of how can we have, a risk and control framework while also stimulating a startup culture. And I think that those things have obviously been forced to align, because customers' expectations, to your point, is that this product is secure first and foremost. They can trust it. And for the banks that are going to be taking the assets, they need that level of security to even do the partnership. And the regulators putting some weight behind guidance to allow these partnerships to happen is huge for us, because we might not have open banking. It's a lot more fragmented, even if we did, because every state is going to have their own opinion if you're doing lending, and there's different parties to get involved because we are a highly fragmented regulatory system. But each of them coming out, you've got the FDIC rule coming out, but then the OCC, Brian Brooks throwing his weight behind it. That's a huge win. And it eases the mind for the financial institutions that are thinking, yes, I do need to move forward technology-wise, but there's this level of discomfort with, is this safe? And regulators are saying, not only is it safe, it's going to enable you to survive this thing, because consolidation is coming and you need to adapt or die.
Well, and the level on top of that is, and there are members of our society and services that need to be provided. And part of the connecting link between what you're talking about and what Jim's talking about is, Lindsay, you're talking about, I'm going to call it a macro culture. Jim's talking about the micro culture within each organization. And there are too many opportunities for misalignment today. And we have a for-profit motive in this industry, in this country, that says, hey, you need to go take care of these customers, but we know you can't make any money at that, and that's your problem to figure out how to do that. So when that becomes
sorry, you were saying?
Yeah, no, and so there's actually some regulatory cover that says, look, we're going to mandate the following things and the following services. That's part of what I was getting at with Jonathan, is the advantage of at least government making some rules. And I know individually we go, hey, that's the last thing we want, is the government coming in and telling us how to do some things. But then this is where that scale comes into play that Jim's talking about, right? If you're not big enough to be able to take the hit on some of those things, it's really hard to serve your entire customer base very well.
Yeah. And Jonathan was mentioning that some of the challenger banks are burning cash right now financially. Fintechs have been put on notice. They need to be on a path to profitability. They can't continue to subsidize these products and use them as loss leaders to acquire customers. And you see it with services that they're starting to integrate. They can get to monetization faster than a traditional bank because they do have a less cost-intensive model. But it's certainly a part of being a functional business, and companies, especially fintech companies, are going public now. You see it, there's a transition there, but it takes time. I think that there's a lot of emphasis around getting there now, especially during COVID. Like, are you going to be able to weather this thing? But there's deep thinking about, how do I be on a path to profitability without sacrificing on the customer experience? And to Jim's earlier point about, willing to pay, I think that there is, I will pay for this service if it provides a service for me, but I will not for a utility that's an expectation, like free checking, right? Like the idea of getting charged an overdraft fee versus I will pay a subscription service if you are advancing me wages on my next paycheck because I'm in between pay cycles. Services that are needed and value added at the time.
So Jonathan, are you seeing the same trend in Europe in terms of this put on notice? Starling is talking about their approaching and passing profitability. We've heard mixed things between Monzo and N26. Haven't had some of the high flyer IPOs, but we, on the flip side, have seen what happened with Wirecard. How do you see this beginning to play out from, a safety and soundness?
Well, okay. In Europe, it's probably a bit different once more from the US, because you're highly regulated and supervised. So basically, these new players have, to prove also that the way they're spending their money and that they will become profitable in a future and so on. So basically, the risk for the end customers, it should be covered, right? Which is probably a bit different in other countries. So their goal, and you're talking about the Monzos and the N26 of this world, is indeed to, and they have started, at least from what we read in the press, that they're either break even or even generating profits and so on, which is very new. And we didn't expect that. Once more, I started pitching to banks 10 years ago. We were focusing on mobile payments at the time. And from now we switched to RegTech. But 10 years ago, we were telling these banks, you should look at PayPal. That's the ultimate threat to you. They're going to disintermediate you. They're going to, it was the scarecrow at the time. No one was really considering them as proper challengers, actually. Now you see all of them, and not even speaking of Alipay with their almost 1 billion users, but and you put all of them together with Tencent and so on. They're the largest money market fund in the world, basically. But if you look at those in Europe, there is another challenge that you don't have in the US, and that probably they don't have in China, which is the fact that it's a very fragmented market with different languages, different cultures, but still they're doing very well in terms of acquiring new customers. I would be interested actually to see the real impact at this stage on the incumbent players. Some of the banks in Europe, SocGen and the BNP and other large banks have announced that they're going to downsize, because it's not only the effect of low interest rates, and they said so in their public statements, saying it's the impact of digitization, the impact of these new players and so on. So I would be really interested to, get a deep dive into their balance sheets and see what is the true impact of these players. But clearly, they're showing a trend. And that's more interesting, because going back to the initial points there, it's what are you, us, me, all of us basically expecting from a bank? We want a bank to provide the best service, and it's easy nowadays to switch from one bank to another. And costs, yeah, there are some costs, but they're going to fight for the churn. They're going to fight for new customers. So they're going to, basically discount it or provide it for free, because they need the customers. They're losing customers to these new players, or they're potentially losing customers to these neobanks that are now providing the services and the bank products that are actually generating margin. That's, I think, something that
if you looked at 2021, I think the biggest threat is what I call silent attrition, which is those customers don't really leave, but the relationships get even more divided, even more fragmented, and go elsewhere. My early conversation with Lindsay was around the fact that PNC had my balances. They do not have my relationship. The real transactional engagement, the real caring about who my fintech player is with PayPal and Stripe and Acorns and Venmo. And if you're a younger consumer, if we get back to the Gen Z and Gen X, they don't even care. I'll never forget that some people have heard this way too many times, that at that point, my 16-year-old guy that did my lawn for me, that's now 22 years old, came up to me and goes, "Hey, would you accept have you ever heard Square Cash? I said, well, yeah, I talk about it regularly. He goes, well, you pay me with Square. And so I didn't let that go. And I said, yes, but I said, why? He goes, because when you pay me with cash or a check, I got to go to the bank. And I don't want to go to the bank. And I told him I would pay him $10 every time I use that in a presentation. The kid just got $10 bucks richer today with this. But the reality is that's a bigger concern. Those financial institutions, everything's the same. Consumers still want to come to the branch, and they don't realize what they don't see because they don't track.
Jim, that is a great way for us to begin wrapping this up. Let's go through, we all missed predicting the pandemic. You just made a bold prediction around 2021. Lindsay, what is your flyer of a prediction? Not that AI will rise and digitization accelerates, blah, blah, blah. But what's your prediction that you don't think is getting enough attention for 2021?
Embedded payday.
Embedded payday is in payday lending?
No, every fintech company that is offering a deposit service or a savings service or some sort of brokerage account or a Venmo account or any type of financial product that is holding cash, it's wholly unoptimized in the consumer's account today because of they don't have a charter, they don't have the ability to lend it for whatever reason. The ability to fractionalize the paycheck, to go direct to the payroll provider and to be able to direct deposit those funds however that consumer sees fit is being unlocked by technology. There's a lot of complexity around payroll, but we're all talking about a point of time in which funds are already deposited in a consumer's account and they sit there. You can't necessarily know how much that person makes from a gross perspective, a net perspective, what type of worker they are, what type of employer they are. How can you advise someone financially if you don't understand the financial, history behind their employment and their income?
Yep.
And I think that every service that holds cash is going to want to be able to optimize that for their customer, depending on how they are financially.
Well, let me restate it a little bit, which is you're talking about that fractionalization moving up the supply chain. Today it happens, something Ron Shevlin and I talked about it on an episode earlier this year, that your bank account kind of acts like your financial router. The money flows in a lot of cases it's flowing out. You're saying that router is moving upstream.
Yes, because it's happening after the fact that those funds are deposited, and consumer behavior is such that they see a paycheck, they spend it. If you don't necessarily deposit those funds all directly into one account, you put a portion of it in a pot, as they call in Europe, or a savings account, that's way better off. The consumer is way better off in the longer run because they have some sort of, buffer for those emergency events and those contingency plans that they otherwise didn't have. And then again, the ability to lower the cost to service somebody, they now have the ability to open a brokerage account for free or have a robo-advisor manage their money for 25 bips. Things that didn't necessarily exist when the checking service was set up, but now they qualify for it financially because it's accessible through technology.
Jonathan, what's your big prediction for 2021?
Well,
Other than gin consumption is on the rise.
And once more, not for kids, right?
Mother's ruin.
Well, beside the APIization, I believe that for 2021, it's probably optimizing KYC AML processes, because the banks, and once more, it's probably the difference between Europe and the US, but there's a lot of pressure, regulatory pressure on the banks in Europe to make sure that, all these know your customer, anti-money laundering procedures are in place, are very well monitored, are strictly implemented. But obviously the pandemic has impacted the customer behavior. So they're expecting a better user experience, the banks to be more user-friendly. And the banks basically need to optimize their costs so to become more efficient. So consuming APIs that are going to help them optimize the account opening, all the processes, the internal processes for the front offices, for the back offices, is clearly, I see it as the trend for 2021.
You don't
JP.
think Jonathan, sorry, you don't think AML KYC optimization is being done in Europe as well?
No,
It's
no,
interesting.
it's
Given the RegTech, I mean, RegTech has really been born out of Europe. That was a category I brought to market at CB. So I'm very curious how
you're absolutely right. But if you follow there is you've got to follow the regulatory also agenda, and there is a new AML5 directive. So there are new rules coming in. More and
the ability
more,
to keep
and
up.
you've got to keep up with the pace of that, which is challenging actually. And we mainly work with large private banks, wealth managers, but also these new players. We mentioned some of them that are. It's funny enough because they're supposed to be the more agile players, coming into the market, but still, it's very, very manual processes that are in place, which is strange, but it's obvious because keeping up with the pace of these new regulations is very difficult.
JP, what's your big prediction?
Well, first of all, I'll join Jonathan for a gin anytime. Jim, next time I'm in Cleveland, we got to have a Great Lakes Christmas ale together. That's
there we go.
My holiday drink. I think we have reached bank peak profitability at the end of last year. There's a profit crisis coming this year and next year, and I'm shocked at how little the industry is talking about it. Look at the economic markers. Look at slowing growth and lending and all sorts of things. And the banks that weren't already kind of addressing this are going to be harder hit. What about you, Jason? What's on your list?
Well, building on that, I've been saying for a while that, sometime in the next 7 to 10 years, we're going to see a halving of the number of financial institutions we have. I actually think the sideswipe is going to be accentuated by the fact that we have been seeing record profits, first benefited by a tax cut, the windfall of fees coming in from PPP, deposits are flush, right? They complain about low interest rates, pushing on NIM. But I think what we're going to see is there's just been this massive acceleration on who those innovators are, the big companies, the tech companies, the smaller ones, that my tip in a series coming out on this over the holidays is really on, we're going to move from thinking about banking, which is at the center of money, to financial services need to move to the edge of money. Money is a means, not an ends for people in how they're conducting their lives. And even the challenger banks we see in the robos become so money centric. And I forget who brought it up earlier in the show, but these artificial silos, right? I think it was you, Jim. It's like, oh, this is my savings money and my retirement money. It's just kind of money, right? And it's that host of experiences that are going to need to be optimized around. So, my prediction is you're going to see the survivors are moving out of banking and into embedding into those things. And as a result, those whose strategy is to be a bank are going to go away.
I'm going to give a quick one just to end it up, and on JP's a little bit. I see a Dow of 20,000 next year. I think we have a come to Jesus moment globally. There's been a whole lot of money pumped into the system that has got to be paid back somewhere. Yep. And I think there's a lot of false, JP, we've talked about it before, a lot of false narratives out there about how the economy is doing. Walk down the street of New York, Lindsay, and you feel it. You feel it in London. You feel it in the shutdown, and it goes beyond the shutdown, because once the shutdowns are with, the immediate pain is gone, but people still can't pay their rent or their mortgage. And somewhere, somehow, that impacts everything. I think this Christmas is going to be one of these blowout things where people are going to try to do everything they can for their kids not to get impacted. But next year's going to be a different story. And I'm an optimist. This is scaring me even making this prediction, but I don't see a pretty road right now.
Yeah. Well, with that note of optimism, let's hope that the efficiencies brought on, by technology, that this global reckoning, that, we do find our way out of it, bigger, better, and stronger in how the system, is finding those markers. So thank you, everyone, that you took time out as you're in your holiday preparations to share your thoughts on the future of banking. and let's see which one of us got it right on the bingo card for next year.
Looking forward to it.
Thanks.
Everybody.
Thank you.
Merry Christmas to you all.
Merry Christmas.
And
Happy
to all a
holidays.
good night.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.